Welcome. My name is Corey Ann Campbell, and I am the Small Business Consultant for Project Solutions. Myself and Greg Hansen, who is the Business Project Specialist and CFO for Project Solutions, will be presenting a training today on behalf of the South Dakota Department of Transportation DBE program. The training topic that we're going to cover today is whether to lease, rent, or buy. It can be very challenging when determining how to best acquire equipment. The goal of the presentation today is to provide some considerations to you as you make the decision. In our training today, we're going to cover the following learning objectives. We're going to discuss rental options. We're going to cover various leasing options. We're going to challenge you to think about strategic considerations in your long-term planning for your business. We're going to go over ways that you can finance your equipment purchases, and we're going to look at how equipment costs impact job costing. We're going to also discuss the income tax considerations and the implications. I want to thank you for your time today. I hope you enjoy our presentation and get a lot out of the information that we share with you. Thank you.
Thanks for watching, everybody. We've developed a library of topics, hopefully that you'll find useful as you plan your business. And firms are always tasked with trying to decide what's the best way to acquire equipment. And so we're going to talk about some of the topics that relate to that. And the first one we're going to look at is rental. Rental pros and cons, where each of the options will have the same thing. So one of the advantages of renting is it's flexible. You return it and the payments stop. And in the short term, it's a low cost. But in the long run, if you rent it longer, obviously it's going to cost more. So the daily cost is higher. Another risk is if when you need it, it might not be available. So if your rental company doesn't have it around and you're ready to go, that's a problem. So pros and cons of renting. On the next slide, let's assume you decided to keep it longer and say it's over here on the left side. You see, for the sake of argument, that it's $570 a day. A week is $1,308, and a month, so on. And so, but if you bought it, we just want to illustrate that is deciding if you need to buy it. It wouldn't take very many months of rental where it would have been cheaper to have bought it. So you got to consider, though, the financing costs, maintenance costs, and then the depreciation and obsolescence. We'll talk about some of that coming up here. So yeah, rental is definitely a great option, but for short term, right? Short term, when you're done with it, you got to take it back, and your obligation is over. But increasingly, we see, we'll go to the next slide, there's different kinds of leases to consider. And one of them that is called a pure lease, or an operating lease, and a capital lease. We're going to discuss each of the three, capital leases being the most common one today, depending on your needs. So let's talk about these as they relate to for a contractor.
Okay, and so moving on, we're going to specifically discuss the pure lease. And Greg, can you tell us a little bit about how the pure lease is in comparison to these other options?
Okay. Well, so in a rental, when you take it back, the clock stops, the money stops. A lease, if you say, I want to rent it for 90 days, I want to lease it for 90 days, or 6 months, you owe the full length of the lease. You can't, if you finish early and need to take it back, you owe the whole thing. So there's disadvantage to it. But the unit cost of a pure lease is less than a rental would be. Same thing here at the bottom. There's no option to purchase or renew. It's not the intent of either party for you to buy it. So again, so compared to a rent, it's cheaper per day, but you are locked into the length of the lease.
So would you say that a pure lease is pretty common, or are there other leasing options?
I think there's maybe some better ones. Again, if you're doing say if you're building a house for somebody and you need a backhoe, you got to put the foundation in and dig it. You might need it for a week, 10 days. Sometimes if you're building several of them, you might need it for a couple months. And so in that case, a lease would be more advantageous.
Okay, so then another type of lease, the operating lease, can you talk a little bit about how this one is yet different?
I think that's one of the things here, it's required for a specific duration, and this, maybe it is this illustration of looks like a pump truck that you need it for maybe 6 months or a year, and, or more. So, and it's not intended to be bought out. So the cost is less. So if you're gonna buy it out at the end, like in a capital lease, which we're gonna talk about in a minute, the lease rate is higher because at the end of it, you're gonna buy it for $1 or $100, whatever. So in this, an operating lease in that example it's a lower cost because at the end, there is no defined buyout. At the end of the lease, you can buy it if they'll sell it to you at a price you want. But anyway, so a pure lease is for narrow window. Operating lease is gonna be a longer term and maybe a specific, but it's cheaper because you're not gonna be buying it. The equipment goes back to the owner at the end.
So ordinarily, people that seek out a type of leases like this are individuals that are probably pretty sure, pretty confident they're gonna have use for this particular piece of equipment for a set period of time.
Right, and they don't want to necessarily own it, or they are attracted to the lower rate because they either don't want to or can't afford to own it at the end.
Okay.
Or maybe they don't have a use for it at the end, so.
Okay. Well, then that leads us into, what are some of the, issues that might come up if you want to own a lease, have a lease.
Yeah, right, good point, Ann. Canceling a lease is not a path you want to go down because it's very expensive. And you owe, just like if you ever rented an apartment in your life, if it's $800 a month and it's 12 months, that's $9,600 you owe the landlord. At the end of 8 months, you want to leave. They may negotiate the balance of it, but you're committed to the 12 months. And same thing in a lease of equipment. You're obligated for the total obligation of the lease. So, and if you can, there's some value in the equipment that goes back that can help on that, but that's not a good thing to want to cancel a lease.
So it's probably pretty important to understand the terms that you're agreeing to when you sign that lease, because even if your job ends and you don't have a need for that equipment anymore, you're probably not going to be able to get out of that commitment.
Correct.
Okay.
They may swap you other piece of equipment, may give you credit there, but otherwise, yeah, so you don't want to cancel the lease.
Okay. So moving on now, the capital lease is a lot different than the two that we've just spoken about. So
Right.
Can you tell us a little bit about
So I
that?
think this is probably the most common one. I don't have any, anecdotally, I can say that because most people do at the end of the lease would like to buy it. And this Caterpillar, this Traco pictured here, is probably, I don't know, $400,000 to $600,000 cost. So the payment on it is significant. So having it set up so that it is a longer term lease is probably more advantageous. And there is a purchase option that both the leasee, the leaseor, know that going in, and the title of the property will transfer at the end of the lease. And there's an asset at the end. So this is a relatively very common way for people to acquire some of this equipment. This is a $500,000 piece of equipment. It's the same applies if it's a $50,000 piece of it, that you have it for 3 to 5 years at a defined rate. At the end of that period, you can purchase it for $100 or $1,000, which is pretty attractive, because this is. But if you're going to sign a 3 to 5 year lease, you want to make sure you can keep it busy. So hopefully that's a whole other issue, I guess. You can't afford to have this sitting very long.
Well, and as you mentioned, this is the most popular form that people tend to commit to, and you can see why, because there is a chance that if you do see it all the way out, that you do have some equity into the equipment.
You can have some equity, yes.
Okay. So can we just take a look at what that exactly looks like in terms of an example? if I were to lease, use a capital lease?
This is, say, on the left-hand side, we have, it's a 3-year lease, $800 a month. Total obligation is $28,800. And the asset has value, and you agreed that you're gonna be buying it at the end, but it is depreciating though. So the purchase price of it was say 24,000. So you can see, if you would have paid cash for it, you could have bought it for 24,000. Well, you're leasing it, and you're gonna be paying $28,800 for the same thing, okay? And say after 12 months, you wanna cancel the lease, for the sake of illustration, and say it can be sold for 15,000. Well, they're gonna take away what you've paid them minus the balance of it, and there's $18,400 is due. You're obligated to pay an additional, not only give the equipment back, pay another $3,400 to get out of the terms of the lease. So something to think about here. The leasee may owe overage charges. Anytime you lease something, if any of you have, you may have been through this, where the machine or the car or truck is quoted at a certain number of hours, certain number of miles, and if you go over that, the fees are significant, because the more hours or miles on it, the less the equipment is worth, and that sort of screws up the math they've planned on when they figured out what your payment is. So, yeah, so what I've heard for cars, can be like 70 cents a mile if you go over it, and heavy equipment, the same thing. So just keep that in mind. Interest rates on a lease are higher. It's more convenient. There's usually not much of a down payment required, so there is a slightly higher risk.
But where you had spoke about the pure lease and the operating lease, the biggest difference again is that there's actually, the equipment can be sold in this case.
Yes.
Okay, so that is.
But it can be sold, but you're probably still gonna owe.
Yeah.
Just saying.
Okay. So if we take a look at, trying to make good decisions for our business, there's some things strategically that we need to think about. Can we take a look at what those things we might want to consider?
Well, in strategic considerations has to be weighed against the owner's goals or objectives. And I've had one client says, I'm not in the equipment business, I'm in the construction business. I don't want to own equipment. I don't want to tie my money in equipment. So I'm going to lease it or I'm going to rent it. Okay. So other people see it the other way around. I want to build equity. Even though it does depreciate, I still have an asset at the end. So what are your goals, Mr. or Ms. Business Owner? I would say. So in addition to that, though, how expensive is the equipment? Can you afford it? Really? Sometimes you can't afford a you're just getting started, $500,000 piece of equipment. How specialized is it? Another thing. We had a company who was doing cutting the road in the forest, and there's a special track hoe that's made just for that. He said I could do the work in twice as fast as if I used a traditional piece of equipment. So, how easy is it to acquire? How often do you use it? What are the financial options? Weighing all those things together, and only you can answer. So sometimes if we talk to you, we can help you with the questions. Obviously, the answers are yours.
So basically, it just depends on the situation and where the business is at, and
That's a good point, Ed. Where they're at. You're just getting started. So it's renting, leasing. But keep in mind, your competitors have been around a while. They may own their equipment and they can bid lower than you, and so that can be a challenge.
Okay. So if we want to take a look at another reason why people might, just going off of that line of thought, where the business is at, they're a young business, why would people choose leases?
Yeah, well, one thing that's easier to obtain.
Okay.
You talk to your bank, they want 20% down, 30% down. The title is yours though, and a lease, the title remains with the leasing company. They still own the equipment. It's a lease to own, right? So you don't own it technically until you fulfill the contract. The business loan is the other way around. Keep in mind the business owner's personal credit score will be the deciding factor in both of those. So if you think, well, this is a business loan or a business lease, it's not me, but that's not the way that they view it. Your personal credit score of you and your business partner, whether that's your spouse or whatever, will weigh in that as well. So, but typically leases are easier to obtain, less down payment, if any.
So a realistic consideration for
Yeah,
maybe
yeah,
a young
yeah,
business. Okay. Okay, so then when we talk about leases in general, what are, in our strategy, what are the other things that we need to really think about?
Well, a couple of things. So your overage charges, if you use it more than you thought you would, there's a shortage clause in the contract. Interest rates are often a lot higher than a bank loan. All payments are due during the term of the lease. You can't just say, I want to stop and give it back. It's not gonna work that way. That's why you're penalized for early termination of lease. So when you buy it, if you buy it from the bank or borrow the money, and no matter how many hours, right, or how many miles you put on it, it's yours. There's no overage charges. So
A lot of things to
a
consider
lot of
there
things, yeah,
and
yeah.
weigh out. So when, one thing that is important to remember, I think comes down to, how this impacts your, financial situation too.
So this has only been, I think, don't quote me, I think it's the last 10 or 15 years, where a lease would have to go on the balance sheet. If it's a capital lease, meaning it's at the end of the lease, you're gonna own it or buy it, you have to put the liability on your balance sheet as well as the asset. So think about it, folks. If you bought something for $100,000, you have no down payment on it or no equity in it, on your liabilities, another $100,000, that's quite a bit of leverage. So it does impact if you're talking to a bonding company about getting bonding for your business. That will raise the risk of your company, raises the ratios, debt to equity, and it won't blow you out of the deal, but it does impact. If you borrow 100% of the cost of buying something, even though in your mind, I didn't buy it, I'm leasing it.
Yeah.
It's not recorded that way on your financial statements, so something to think about. So some people, they would lease it to sort of get around having to have it on the balance sheet, but it's not the case anymore.
It's a good thing to know.
Yeah.
So moving on, when we want to consider a bank loan, what would we need to think about?
Well, the bank's going to want 25% down probably, depending on your bank. Also, I think if you're, as you said, Ann, where the business is at, every business needs a banker, and building a relationship with that person is essential, whether it's a line of credit or equipment loans. And there's no overages, there's no surprises. Make the payments for the number and at the end, it's yours. You have equity in it. So it is a liability just as a lease is, but definitely if liquidity, if you can afford the down payment, maybe that's the way to go. Starting out it might be a little tough, but
One good things to think about.
yeah.
So moving on, if we are talking about leases, what are some of the financing options that we need to consider?
Well, I think this is, we put this slide in because manufacturer financing is the easiest to qualify. We got some bulleted points over here. Maintenance is often included in the lease price, and they often offer the most favorable terms, a little down payment, because their collateral is the security and the equipment that they know everything about it, because right, they're the dealer for it. They do your personal credit score, right, and they have a ready resale market for used equipment. So, if the deal goes south on them and they have to take it back, they can sell it like that. They know it's been maintained because they're doing it. So it's like I say, a manufacturer's business model is built on returned lease equipment, because you come back in, you're a customer. They don't need the down payment like a bank does. Payments are going to be higher. Interest rates going to be higher, but it's easy.
And you can see why it's easy, because they want you to lease.
Yeah, whether you lease it or they'll loan it to you, they'll loan you the money to buy it if that's what you want. But either way, it's very attractive, no question.
Okay, so if we take a look at, the opposite to purchase the equipment outright, can we talk about the things that we need to consider in that decision?
Yeah, I think, if you want to build equity, this is the ideal way to do it. And maybe that's not a priority for you. Back to your strategic considerations. You know, buying it does build equity. Down payment is either cash, which ties up capital, so that's right. But it can be a trade. It can be a trade-in. Maybe you have an older one that can provide some of the equity that you need for the down payment. So it doesn't have to be cash, right? It could be equity you have in another asset, another tractor or whatever. So it is cheaper in the long term, no question. And I mean, the equipment's available when you need it. You don't have to call anybody. You don't have to coordinate it. You just need to get it on your trailer and get it to the job site. So.
And that could really be a problem if you cannot have if your equipment isn't available when you need it. That could cause a huge wrinkle in your plans.
For everybody, yes.
Okay, so other things to consider.
Tied up liquid, as I mentioned. If you have to put a down payment or financing ties up your liquidity. It's leverage, as I said. It goes up. It could impact your bonding capacity. I want to mention that owning always costs less to own, right? We hear that. So if that ultimately owning it is cheaper, builds equity, and you have an asset, is something you can sell someday, or builds value in your business. And when you do need the equipment, it's in your yard. You load it up and go.
Okay, so I think we want to move on and talk about some other things just to consider, like not saying one way or another if somebody should buy or lease. What are other things that we need to really think about when we're trying to decide which to do?
I think the technology, that's always important. Some of the new, even the earth moving equipment, you think that's pretty basic. It just scoops up dirt, but there's computers that drive it that help dig and maintain. They're more fuel efficient. Some of the new machines don't use as much gas. Opportunity cost is a big thing. If you tie up $500,000 in a piece of equipment, that's $500,000 of borrowing base or liquidity that you can't go do something else with. So there's definitely. I think buying new equipment, the warranty is big. That's a big part of it. It's easier to calculate your equipment job costs. But I think the opportunity cost and ties up capital is two big considerations.
So can you talk a little bit more about what you mean exactly by opportunity costs?
Sure. We all have those. We could have. Thinking back to your day when you got out of high school, you could have went and got a job making X dollars, or you could have gone to college or tech school, whatever, and made zero, right?
Yeah.
So, and after 4 years, if you'd been working, you would have 4 years worth of earnings. But instead, you went to college or trade school, whatever you did. So there's an opportunity cost. That's a good, relatable experience to people that for 4 years or 2 years, whatever, you gave up earning capabilities to go do something else. That's an opportunity cost. And how long would it take you working at hopefully a higher wage later on to earn back that opportunity cost? Or if you decide to move to another location for another job, it doesn't work out, and you should have stayed home. Those are some parallels. Can you think of any opportunity cost situations that you've seen where you can kind of weigh one against the other? There is a cost to it, even though you're maybe not writing a check for it. There is.
Well, if I take on 3 jobs that require a specific amount of equipment or a specific type of equipment, but all my resources are tied up in another sort of equipment, then I'm going to run into a problem being able to fulfill the obligations I'm trying to commit to because of obligations that I've already committed to. Wouldn't that be what the problem might be?
Yeah. There's, but if you have $100,000 liquid cash in your business that you could put towards a new piece of equipment, or you could use it to build as a spec deposit to build a spec home property, and you just choose to do A over B, there's a cost plus or minus on each of those situations. There's always going to be opportunity costs in business that you had to give up this to do that, and what's that cost? And sometimes in dollars and cents you can calculate that.
And so it just comes down to, like, when we're considering whether to rent or to buy or to lease, it just is how that decision is going to impact what we might do in the future.
That's correct, yes.
Yeah. Okay. So when we consider equipment costs and job costing, how is the lease versus the buying, how is that all figured? Because job costing is a huge thing in construction.
It's the holy grail, I
Yeah.
would say, for contractors. Well, if you're leasing it and you write a check every month for $500 or $1,000 to the leasing company for a piece of equipment on a job, it's done. The job costing is done, and it's defined. And so if you wrote the estimate using that amount, your plus and minuses are zero. But if you own it, you can charge that same rate, but it's going to cost you less to own it. And you have to put all the costs associated with that equipment into a bucket. And if you give us a call, we can help you with that part. But what we see here in the second bullet is charging too much for equipment on a job can cause the estimate to be too high. And sometimes as we talk to small businesses, they'll say, XYZ company just blew me out of the water on my bid. They were way, way lower than me. Sometimes it's how they calculate their equipment costs. So the goal is to get the total cost into the final bid. So at the end of the day, your customers are paying for the equipment, not you. And tracking the equipment in these buckets we call accounting buckets will help you get there.
And so a lease is easier to track, right?
Yes, yes.
Yeah.
Just okay. One check typically.
One check. Okay. All right. So when we talk about that a little bit further, and dig into that, can we just cover exactly what that would mean in terms of making the accuracy, making sure we're accurate?
Yeah. So when you own your equipment, you have to determine what internal rate you're going to charge. You're going to charge yourself or charge your projects. And if you want to use a calculated rate that you've done against using your actual costs, or you can use a rental rate, or you can use a lease rate. There are rates that companies can use standards to apply when they create an estimate. And then you can use your actual costs during a time period to weigh against the estimate that you've used in the incremental rate, whether if it's $400 a day and you've done the math, you're charging $400 a day, and you've done the math over a 6-month period, you think, geez, I could have charged $200 a day for this. Do you, bidding going forward, use $200 a day? Or do you use the $400 because that's what the going rate is in the market? So without having adequate job costing for the company-owned equipment, it's going to be very difficult to have that information. So accurately estimating equipment costs can be done by using, use the word bucket, put all the costs into a bucket, then allocating that to jobs in an equitable way. Back on opportunity costs, it's difficult to quantify the cost of breakdowns or downtime from lack of availability. So back on leasing, renting, owning, if you have a job and you have a crew of people ready to go to work and the tractor's supposed to be there in the morning, it doesn't come till afternoon, you're paying your people to stand there, the subcontractors are mad at you because they can't do what they need to do because your tractor didn't show up on time. Yeah, that's a little out of the line of this, but that's a very real example of leasing, owning, and having control over your equipment. But I think using the cost of equipment to accurately create your estimates is essential. And you can decide if you want to charge the going rate or what your calculator rate is. And your calculator rate, I'm sure, is going to be less than what the going rate is.
So, and just to kind of circle back around to the previous slide where we were talking what goes into actually estimating a job cost, so even though it's easier to do this with rented or leased equipment because it just, like you said, you just have that number that you can plug in there, That doesn't necessarily mean that that's the best decision long term, because you still have to consider that the cost of the equipment, if you buy it, is lower in the long term. And so even though we're saying here in this particular slide that it's easier for job costing, it doesn't mean that it's the best decision, because you still have to consider those overall
Sure.
expenses.
Yeah. So if you think about when you lease or rent anything, included in the cost of that is the cost of supporting the company that owns it. So you right there, you know that those costs are going to be higher. And if it's a short term, maybe it makes sense. But ultimately, if you can own it and you put the fuel, the repairs, depreciation, all of it into one bucket, and you can divide that number by the amount of hours or miles, you can get a good sense of what it costs you to own that equipment. And again, then how much do you charge the job? Do you use as I said, the calculator rate, or if you overcharge on it and you're not winning bids, that might be why, because you're charging too much, the rates are too high, and you're making too much money on your equipment. So definitely, we've been talking to some clients who are going through this analysis, and they're finding out that they've been charging more on their jobs than they need to. They're charging more for their equipment than they need to. Kind of an eye-opener.
Yeah, that's a really good point that you made there. So, and then it leads right into our next slide here when we were talking about saving in the long term. Again, it's like we can't just focus on what's easiest and what seems the best right now. We do have to keep in mind
Sure.
our long term.
Yeah, and I think you've got to think that's, gosh, and strategically, what are you in business for? Do you want to I want to try this construction thing for a few years and see if it works. I don't want to tie up a lot of money in case it doesn't. I don't know, but so that's things to think about. So if you have a line of credit that's supposed to be for seasonal needs, and you see a backhoe for sale somewhere for 50 grand, you think, oh, that's a deal. I'm going to buy it, and you use your line of credit to pay for it. That's really hard to get that back. That's very hard to get that back. So really avoid that. See that a couple times. You go to an auction and they just get too excited and they bid on something that they use their line of credit in the middle of the winter. They run out of cash because they didn't finance it, didn't plan it right. So banks, remember, the banks will finance purchases, but they require a bigger down payment, which could be in the form of maybe they can take a second on your shop or second on your house. That could be collateral. You don't have to it doesn't have to be cash, so keep that in mind. And even though the upfront costs are typically higher, owning equipment does build equity in your business over time. And that is something when somebody want to sell, or to your siblings or children or your employees, there's some assets there that have value that becomes collateral. So
that's a really good point. So when we talk about another thing to keep in mind, when people, you got to think about the tax implications. So
always,
can you speak to that?
Yeah. So we've got to put this in here. Well, if you rent it, obviously you don't, and only under a capital lease does this apply, or when you buy it. But Section 179 of the IRS code allows equipment to be purchased or leased can be depreciated 100% in the year it was put in service, up to a maximum of $500,000. So that's really, really attractive if you need a new piece of equipment. So visualize it. It's December, it's cold, and you're not working, and you're looking at your records, and your accountant says, you're going to have a hefty tax bill this year. You had a good year, and if it makes sense for you to buy that new tractor or that new fleet of trucks, whatever it is, maybe it does make sense to purchase those before the end of the year to reduce your tax bill for 2022 or whatever year it is. But in the following year now, those assets have been depreciated. So this is I always say income taxes are like a pay me now or pay me later. Yes, and we always choose to pay me now, to get to pay it later, excuse me. So you can depreciate it in the year it's bought, but the basis is gone. And say I don't know, for the sake of illustration, say you bought it for $200,000. Next year, you don't need it, and you sell it for $100,000. Guess what? On your books, what's its value? Zero, because you depreciated it. So now you have a $100,000 gain. That's taxable. Anyway, I think we're not definitely not in the tax consulting business, but there's a lot going on there when you buy equipment, good and bad. You know, I don't think it's bad, but keep in mind that I think it's true. It's to pay it now or pay it later. And if you're plan on being in business for a few years, it's good, but sometimes the tax bill will eventually come due. So anyway.
Well, it's important to be informed, you know, and that
Sure.
all of this leads into making a good, solid decision because, again, depending on where you're at and where you're at in your business, a lot of these things may or may not apply to you, just depending on what your situation is.
If you're in construction business, this definitely applies to you, whether you have had good years and need to offset some income, but very helpful in your tax planning and your overall strategy about the business. So.
Okay, so
Okay.
This is just a thing
Oh,
to
yeah.
get people thinking at the end here. What is this true or false? So job site productivity increases with owned equipment. After everything that we said, where we've tried to talk about where are you at in your business and what is, you know, the best decision for you, what would the answer to this be then? Because, you know, it just, I think it goes back to where you're at.
Don't you hate those answers? It depends. That's not a true or a false answer. But right, one person's true is another person's false. You know, so having access to the equipment when you need it, control of it is definitely helps productivity. Having your money tied up in a piece of equipment that's dying, you know, probably decreases productivity. So, you know, each or his or her own, I guess, on the answer to that one. But I think I vote. I think it's true. I would say. And again, there's somebody out there who says, nope, we're just.
We're in a different situation, and
Yeah,
some of this
yeah.
doesn't apply to us. And
Yep,
this is where
yep.
we cannot own right now, and so,
Yep.
but it's thought provoking, right? But I think we've covered some great points about this. So I think in summary, you know, the big takeaway here is that solid financial business decisions made in the short term can position a business for a profitable future. And by that, we just mean that you really have to make solid decisions based on good information. We've tried to cover a lot of different things to think about. I guess in summary, would you want to point out again?
I guess when we meet a small business owner, we always start off with giving them a goal sheet. We ask them to specifically identify their goals for their business and themselves and their lifestyle. And that kind of drives everything else. And owning equipment builds equity, no question. But again, some people say that's not where they want to go. And that's based on their strategy and their objectives. Maybe they have other business interests that conflict with that. So, but I think understanding those decisions are wrapped around the strategic goals you have identified for yourself and your business and your situation that drives that. So, business decisions, not personal decisions. Also, keep your personal situation separate from your business as much as you can. I know that's easy to say, but really, that's if the business of that arm's length relationship between yourself and your business. So, always stress that. I think we also just say, Ann, is that if you're certified in the state of South Dakota as a DBE, our services are free. Here's our phone numbers and our emails. You're welcome to call or contact us with any questions about any of this.
We have a wide variety of topics that we train on. We do individualized sessions with folks, and so we hope that you'll reach out if there's anything that we can help you with. And again, thank you for your time today.
Thank you for tuning in, and again, if you have questions, let us know. Appreciate your time.